Picture this because, well, it's a scene that plays out all the time, and it drives people absolutely crazy. You're sitting at the kitchen table, having your morning coffee, and you pull up the news.
Right, the typical morning routine.
Exactly.
Yeah.
And you see a massive headline announcing sweeping corporate layoffs at some major multinational company. We are talking thousands of workers suddenly losing their incomes.
It's brutal.
It really is. And immediately your mind goes to the ripple effects. You think about families delaying decisions they had planned for months, local spending drying up in the towns where those workers live, small suppliers suddenly getting, nervous about their own contracts.
Yeah, the whole local ecosystem just takes a massive hit.
Right. And yet almost at the exact same moment, the financial ticker scrolls across the bottom of the screen showing that this exact company's stock price has just shot up by 6%. The financial anchors are smiling, declaring that the company is suddenly leaner, meaner, and stronger.
Which feels incredibly frustrating when you watch it.
It feels like the whole system is completely broken. But for this analysis, we are taking a completely different view. Okay, let's unpack this, because our mission today is to decode the hidden systems that explain exactly why the stock market can hit record highs while everyday households feel completely broke.
Yeah, it is a totally understandable frustration. I mean, it is so easy to look at that television screen, see the disconnect between the real pain of layoffs and the green arrows on Wall Street, and think the whole system is just entirely fake.
Oh, absolutely. That's the default reaction for a lot of people.
Right, but I want to reassure you right from the start. This dynamic is not a contradiction. It is actually a vital clue. We so often fall into this trap of assuming that if markets are strong, well, the economy must be strong.
Or the other way around, right? Like if people are struggling, the markets must be artificially manipulated.
Exactly. But both of those arguments are far too simple. The stock market and the economy are deeply connected, and they influence each other constantly, but they are absolutely not the same machine.
Right, they aren't the same machine at all.
Yeah.
To really understand why, we have to look at the massive difference in scope.
Exactly. Think of the economy as the vast, complex operating system where you actually live your life. It is workers getting paid wages, families paying rent and buying groceries.
Hospitals hiring staff, farmers buying diesel for their tractors.
Yes, local factories ordering new equipment. It encompasses production, income, debt, consumption, trades, savings, just millions of separate, daily, messy decisions.
Right, the real world.
The real world. The stock market, by contrast, is just a very narrow, highly specialized marketplace. It is strictly an auction house for ownership claims on publicly traded companies. That is it.
But wait, if the stock market is just an auction house for public companies, what happens to everything else? I mean, my local grocery store or the regional construction firm that just repaved my street, or even massive public infrastructure projects, those aren't on the stock market. Are they just completely invisible to this financial index?
They are entirely invisible. A private business could employ hundreds of people in a town, pay massive amounts of local taxes, sponsor the Little League teams, and be the absolute lifeblood of a region.
Yeah.
But its success or failure will never move a major stock market index by a single point.
Wow, that is a massive blind spot. I mean, judging a country's economic health strictly by looking at the stock market feels a lot like judging a city's livability strictly by looking at the price of its ultra-luxury penthouses.
Oh, that's a great way to put it.
You're looking at the sky while completely ignoring the crumbling subways, the closing local shops, and the actual street-level reality where 99% of people actually live.
What's fascinating here is how the index itself is constructed mathematically, which makes your penthouse analogy incredibly accurate.
Okay, how so?
Well, most major stock indexes use something called market value weighting. That means the larger a company's market capitalization becomes, the more mathematical influence it has over the entire index.
So bigger equals louder.
Exactly. A massive trillion-dollar technology corporation does not get one equal vote beside a mid-sized regional bank. The giant tech company gets a much, much louder voice.
So if you have just a handful of absolute corporate giants having a great quarter, they can drag the entire average up. And that masks the fact that hundreds of other companies in that same index might be totally flatlining.
Precisely. So when you hear the news anchor happily announce that the market is up, you naturally imagine that businesses across the board, from coast to coast, are thriving.
Right. You think everyone is doing great.
But a rising market often represents what we call a narrow rally. And a narrow rally means investors look at the landscape and believe only a very small handful of companies have the massive scale, the proprietary technology, or the ruthless pricing power to actually survive in a difficult environment.
Wait, so it's actually a sign of fear.
Yes, it does not mean broad prosperity. Paradoxically, a narrow rally often signals scarcity. It means capital is terrified. The smart money only sees a few safe, highly scalable places to hide.
That completely flips the script on what a record high actually means. It's not a victory parade for the economy. It's capital retreating to a fortress.
Exactly.
And the disconnect gets even wider when you look at where these companies actually operate. A major listed company might be headquartered in your specific country, but it earns its money globally. Its customers are on entirely different continents.
Yes, the geography gap is huge and it confuses people all the time. A domestic stock index can hit absolute record highs simply because shipping container costs got cheaper out of Asia,
Right.
or a specific currency fluctuated in Europe, or a global competitor halfway around the world had a supply chain crisis. None of those factors require the households in that company's home country to feel a single ounce wealthier or more secure.
So the index is local in name only.
Pretty much. The stock market is often national in name, like the S&P 500 or the FTSE 100, but it is entirely global in its reality.
And beyond the geography gap, there is a massive gap in time. The economy, the one we all live in, lives in the painful present.
It really does.
It reacts instantly when people lose their jobs. It reacts today when inflation makes the weekly grocery bill impossible to afford.
But the stock market trades the future. It is not looking at today's grocery bill. It is asking what corporate profits might look like 6 months, 2 years, or 5 years from now.
So they're looking way down the road.
Yeah, investors might look at a painful current slowdown and believe it will eventually kill off inflation, which means borrowing costs will eventually fall. Or they might believe weaker competitors will go bankrupt today, leaving the surviving giant companies with massive market share tomorrow.
Wow.
The market doesn't wait for the recovery. It tries to price the recovery before the recovery even arrives in the real world.
Here's where it gets really interesting, because it's like the stock market is looking through a telescope at future global cash flows, while the average worker is stuck looking through a magnifying glass at their current bank account balance. They aren't just looking at different things. They aren't even looking at the same horizon.
That telescope analogy perfectly explains the painful layoff scenario you mentioned right at the start.
Right. The thousands of jobs lost.
Yeah. When a company cuts 10,000 jobs, that is immediate, devastating, present-day pain for those workers and the local economy. But remember, markets do not have feelings.
They don't care.
They do not possess empathy at all. They are simply a pricing mechanism for expected cash flow. If a company suddenly slashes its labor costs by firing thousands of people, and investors expect the company's overall revenue to remain relatively stable, then the expected profit margins just improved significantly.
Because the company just eliminated a massive expense, meaning more money falls to the bottom line. And the shareholders own that bottom line.
Exactly. Wall Street refers to it as shareholders having the residual claim on corporate income.
Hold on, let's make sure that's crystal clear for everyone. Residual claims, meaning what exactly? That after a company pays its suppliers, pays its remaining workers, pays the rent on its buildings, and services its debt, whatever pennies or millions are left over in the pile is the residual, and the shareholders own that exact pile.
That is exactly what it means. Shareholders are the last in line to get paid out of the company's revenues, but they get everything that is left over.
So any cut to expenses is a direct raise for the shareholders.
Precisely. So if a CEO can suddenly shrink the size of the payroll, that residual pile at the end gets bigger. The stock price goes up because the math dictates it must. It's not a social scorecard grading corporate morality. It is a cold math equation about future profits.
And when we realize it's just cold math, we start to see how this disconnect actively shapes the society we live in. It doesn't just reflect reality, it changes it.
It changes it deeply. We can see this playing out in 4 very specific hidden ways. It starts with what economists call the wealth effect.
Okay, the wealth effect. How does that work?
Well, the stock market fundamentally rewards owners over wage earners. When asset prices rise, the people who hold those assets, like stocks, bonds, real estate, they become wealthier on paper.
Right, their net worth goes up.
Exactly. And because they feel wealthier, their confidence rises. Their borrowing options improve because banks love lending to people with assets. So they go out and spend more money.
But they don't spend it evenly across the economy, do they?
Not at all.
That wealth effect flows straight into high-end services. It flows into luxury travel, fine dining, and incredibly expensive property markets. So the person who relies solely on a biweekly paycheck watches the cost of entering the asset market, whether it's buying their first home or starting a portfolio, just skyrocket away from them, fueled by the spending of the people who are already rich.
It creates a tremendous widening of the wealth gap. But it's not just individuals getting left behind. Businesses face the exact same divide when the economic weather turns ugly.
What do you mean?
Think about what happens when credit dries up. We call this the capital access divide. Giant public companies can easily survive a rough patch because they have access to the global auction house.
Ah, the stock market.
Right. If they need cash, they can issue new corporate bonds or sell new shares to a massive global investor base. Small businesses do not have that luxury.
No, they definitely don't.
A local manufacturer or an independent restaurant relies entirely on local foot traffic and maybe a single line of credit from a regional bank. When interest rates rise and credit gets tight, the local business gets crushed, while the giant corporation easily borrows its way through the storm.
Wait, if the deepest pockets just continually buy up the market during a downturn, while all the small and medium businesses fail because they can't get loans, doesn't the economy just turn into a rigged game of Monopoly, where the board just gets more and more concentrated in the hands of the players who started with the most cash?
Well, the word rigged implies someone is breaking the rules in a smoky back room. It's actually more terrifying than that.
Terrifying how?
This is the system functioning exactly as it was designed to under these financial conditions. The rules aren't being secretly broken. The rules themselves mathematically favor scale. And because the system favors scale and public market performance, it creates a massive distortion in how companies actually behave.
You mean corporate incentives, like how CEOs actually choose to spend their money?
Yes. Because public companies are constantly judged by this relentless, minute-by-minute market scorecard, executive teams have to optimize for it.
Right, their bonuses depend on it.
Exactly. Their own compensation is usually tied to the stock price, so they face intense pressure to show immediate financial efficiency. Instead of taking a risk and using their cash to build a new factory or hire more workers or fund deep research and development for a product that might not pay off for 10 years, they often prioritize share buybacks.
Because buying back their own shares on the open market reduces the total supply of shares available. And if demand stays the same but supply shrinks, the remaining shares become more valuable. It artificially improves their financial structure on paper, even if they didn't actually build anything new or invent anything better in the real world.
It is financial engineering rather than actual economic engineering. And if we connect this to the bigger picture, this financial engineering bleeds into the political layer, which is the most dangerous consequence of all.
The political layer.
Yeah, governments, politicians, and central bank policymakers watch these stock indexes obsessively. The massive problem arises when a market index becomes the main symbol of a nation's success. It is a very easy green number to put in a political headline.
Oh, it's the ultimate political prop. Every politician loves to stand at a podium and say, well, the market is at an all-time high, your retirement accounts look great, therefore my policies are working and I'm doing a great job.
But when a country starts treating the stock market as its primary economic report card, politicians risk optimizing their policies strictly to support asset prices while completely ignoring the rotting foundations beneath them.
They miss the real economy completely.
Exactly. The stock index does not show whether young people can actually afford to buy a starter home. It doesn't show if real wages are keeping up with the brutal cost of living. It doesn't show if local businesses can get a reasonable loan to expand.
So that brings up the million-dollar question. If the underlying economy is struggling, if wages are stagnant, if small businesses are closing, if everyday people are tapped out of it about what is actually driving these massive stock valuations up, if it isn't a thriving, healthy local economy, what is the fuel inside the rocket?
The ultimate hidden mechanism underneath all of this, the real fuel, is the price of money.
The price of money.
Yes, and the price of money is determined by interest rates and government bond yields. To truly grasp this, you have to separate two fundamental concepts in your mind: earnings and valuation.
Okay, break that down for me.
Earnings are the actual real-world profits a company generates by selling goods or services. Valuation is simply the price tag investors are willing to pay today to get their hands on those profits.
Okay, let me try to put this in everyday terms to make sure I'm following. Valuation expansion is like paying hundreds of thousands of dollars more for the exact same house.
Right.
This because mortgage rates dropped. The house didn't magically get an extra bedroom. The roofs wasn't replaced. The neighborhood is exactly the same.
Right.
The physical asset hasn't improved at all, but the financial math shifted. Money got cheaper, so the bidding war drove the price through the roof.
That is a brilliant way to look at it, and we shouldn't rush past that point. The house didn't get better. The money used to buy it just got cheaper. That is exactly what happens to a stock during a financial boom.
So it's just inflation of the asset.
Basically, the company didn't necessarily invent a better product. The market is just flooded with cheap money looking for a home, bidding up the price of that stock. A share of stock is valuable because it generates cash in the future, but a dollar earned 5 years from now is not equal to a dollar in your hands today. It has to be discounted.
Wait, let's break that down. Why does a dollar tomorrow matter less? And how do interest rates change that math?
Think of it as opportunity cost. If government interest rates are high, you can take your money today, put it in a totally safe, risk-free government bond, and earn a great return.
Right, without taking any chances.
Exactly. So if a company asks you to take a risk and buy their stock for profits they might make 5 years from now, you are going to demand a massive discount because you could just be sitting in safe bonds.
Makes sense.
But when central banks push interest rates down to zero, those safe bonds pay absolutely nothing. Suddenly, investors are starved for any kind of return, so they are willing to pay a massive premium today for those future corporate profits. That flood of cheap money is valuation expansion.
But that sounds incredibly fragile. I mean, if the whole rally is just based on cheap money forcing people to take risks, what happens when the math shifts the other way?
This raises an important question because it reveals what we call the global choke point. The stock market gets all the flashy headlines on the nightly news, but the bond market determines the financial gravity of the entire world.
Financial gravity. I like that.
Yeah, government bond yields, particularly the US dollar, sit at the very center of a massive global web of borrowing and lending. When the global cost of money goes up, when bond yields rise, investors suddenly have safe places to get a return again.
The gravity comes back into the room.
Exactly. They demand a higher return for taking a risk on stocks.
Which means they won't pay anywhere near as much for those future corporate profits, and the stock price drops, even if the company itself is still operating perfectly fine.
Exactly. And this higher cost of money ripples out and hits the real economy brutally. It isn't just a Wall Street problem.
Right, it hits Main Street too.
Oh, absolutely. A strong dollar and high yields hurt emerging market currencies, making it impossibly expensive for developing nations to import food or energy. Domestically, it makes mortgages suddenly unaffordable, freezing the housing market.
It stops major infrastructure projects in their tracks because municipal financing becomes too expensive.
Yes. Highly indebted companies that rely on rolling over their loans suddenly start to drown. This proves that while the financial market and the real economy can diverge and look like separate machines for a long time, eventually they must collide.
Because the fundamentals catch up.
Always. If everyday households lose purchasing power for too long, consumer demand ultimately weakens. If businesses can't refinance their debts, corporate investment stops. And when the economy weakens enough, those corporate profits finally feel the hit.
So what does this all mean? We're looking at a system where a booming stock market can actually be masking a rotting economic foundation.
This brings us to a crucial, highly contrarian insight. We have all been deeply conditioned to think a powerful, record-breaking stock market is a sign of boundless opportunity.
Yeah, everyone cheers for a record high.
But extreme capital concentration, where all the money flows into just a few massive tech giants, might actually be a giant red flag. It can signal that the rest of the economy is completely unappealing to investors. That makes so much sense when you think about it. If the real economy was healthy and vibrant, capital would be flowing dynamically into new startups, into regional manufacturing, into massive new infrastructure projects across the country.
Right.
If hundreds of billions of dollars are all just piling into 5 giant monopolies, it's because everywhere else looks too risky, too fragile, or too stagnant.
Exactly right. We have to learn to differentiate between a productive boom and a financial boom.
Okay, what's the difference?
Well, a productive boom is what builds a nation. It builds new physical capacity, it creates new innovative businesses, improves overall efficiency, and actually supports real wage growth. It expands actual opportunity for everyday people.
And a financial boom.
A financial boom, on the other hand, just increases the valuations of things that already exist. It rewards existing owners, and it makes the real economy more expensive, more concentrated, and far less accessible for anyone trying to break in. It really forces you to ask a tough question about where capital's actually going. Are investors actually building the next economy? Or are they just paying top dollar to buy the best seat in the existing one?
That is the perfect way to phrase it.
Because if it's just the latter, they were just circulating money among existing assets instead of creating any new wealth for society.
And that is the ultimate bear case for these types of rallies. It isn't that markets are fake. It is that they become too dependent on one very narrow story.
Like assuming the good times just roll on forever.
Basically, a fragile belief that interest rates will always eventually fall, or that a few dominant companies will forever maintain unusually high profit margins without facing regulation or competition. When a financial boom is not backed up by a real productive boom, the foundation underneath the market narrows dangerously.
It perfectly ties back to the metaphor we used earlier. The economy is the engine. It's the pistons, the fuel, the actual mechanics of moving forward.
Yeah.
The stock market is merely the auction house, sitting beside the engine, taking bids on who owns the parts. And as a society, we've spent entirely too much time obsessing over the auctioneer's gavel and completely ignoring whether the engine has any oil left in it.
Which is why, moving forward, you need a completely new framework for how you consume financial news. The next time you see a market hit a record high, you shouldn't just passively ask, is this good? You must actively ask, good for whom?
I love that. Good for whom?
Exactly. Are corporate profits rising because customers are thriving, earning more, and buying more products? Or are they rising because companies are firing workers and squeezing their suppliers to the breaking point just to cut costs? Is capital actually building new capacity in the real world, or is it just bidding up existing assets to higher and higher valuations?
Those are the questions that finally separate the real economic signal from the endless financial noise. So the next time the market rises while everyday life seems to get harder and more expensive, I challenge you to look beneath the ticker. Question what the smiling anchors and the bold headlines are missing. Because the most important question is never how high the auction price has gone. It is whether the engine underneath is actually getting stronger.